tell you something, all that glitters ain't gold. Hey, hey, it's been a long old troublesome road, and I'm looking for somebody come and help me carry this load. I need a dollar, that's what I need. Hey, hey, well I need a dollar, that's what I need. Well, I don't know if I'm walking on solid ground, 'cause everything around me is falling down. And all I want is for someone to help me. I had a job, but the boss man let me go. He said, I'm sorry, but I won't be needing your help no more. I said, please, Mr. Boss Man, I need this job more than you know. But he gave me my last paycheck and he sent me on out the door. Well, I need a dollar, that's what I need. Hey, hey, said I need a dollar, that's what I need. Hey, hey, and I need a dollar, that's what I need. And if I share with you my story, would you share your dollar with me? Well, I don't know if I'm walking on solid ground, 'cause everything around me is crumbling down. And all I want is for someone to help me. What in the world am I gonna do tomorrow? Is there someone with a dollar I could borrow? Who can help me take away my sorrow? Maybe it's inside the bottle. Maybe it's inside the bottle. I had some good old buddies, names is whiskey and wine. Hey, hey, and for my good old buddies, I spend my last dime. Hey, hey, now wine is good to me. You help me pass the time. And my good old buddy whiskey keep me warm in the sunshine. Hey, hey, your mama may have blessed the child that's got his own. Hey, hey, if God has plans for me, I hope it ain't written in stone. Hey, hey, because I've been working myself down to the bone. And I swear on Grandpa's grave, I'll be paid when I come home. Hey, hey, well I need a dollar, that's what I need. Hey, hey, said I need a dollar, that's what I need. Hey, hey, well I need a dollar, that's what I need. And if I share with you my story, would you share your dollar with me? Come on, share your dollar with me. Go ahead, share your dollar with me. Come on, share your dollar. Give me your dollar. Share your dollar with me. Come on, share your dollar with me.
All right, welcome everybody to our September Best Practices webinar highlighting ADU finance. I am Rafael Perez, and I am a board member at the Casita Coalition and co-chair of the Finance Working Group. I'm a realtor and board member at the Pacific Southwest Association of Realtors, past board member and past chapter president with NAREP San Diego, the National Association of Hispanic Real Estate Professionals. And I've also worked in the past as a mortgage lender. Today, we have a different format than our typical monthly webinars, where we've focused on cities' best practices. Today, we're actually looking to highlight the available ADU finance strategies and also what financing is looking like even outside of California. We will also hear from Assemblymember Tim Grayson. We will also hear from CalHFA and from 4 lenders who will share a few approaches to financing. Also joining us this morning is my colleague and fellow co-chair from the County of San Mateo, who many of you already know, Mr. Caleb Smith, who will share the stage for this webinar with me. Before we move along, I'd like to thank our major sponsors for the webinar series, Union Bank and, hold on just a second, Union Bank and Facebook. Also, our sponsors of the webinar series, the Stowers team of CrossCountry Mortgage, Umpqua Bank Home Lending, the Building Industry Association Bay Area, Bridge Association of Realtors, and the law firm of Allen Mackins, and Housing Trust of Silicon Valley. All of this couldn't have been possible without support of our promotional partners who are aligned with the mission of the Casita Coalition in creating more housing opportunities statewide. The State of California Housing and Community Development, UC Berkeley's Turner Center, the Association of Bay Area Governments, Sacramento Area Council of Governments, Southern California Association of Governments, Build It Green, the National Association of Hispanic Real Estate Professionals, the Bay Area Council, SPUR, FACE LA, Faith and Community Empowerment LA, California Planning Roundtable, California YIMBY, Circulate San Diego. This past March, our working groups developed and released 2 new resource guides. These guides are available on our website, but can also be found on the HCD website. One is the Garage Conversion Resource Guide, and 2 is the Finance Resource Guide. Later this year, we will have a Best Practices Guide highlighting the best practices and key takeaways from this year's webinar series. If you'd like to get more involved in any of our working groups, please become a member and get more involved with one of our working groups that are currently focused on the following areas related to ADUs, small housing, and the missing middle housing. Codes and constructions, local government implementation, finance, professional resources, and multifamily working group. If you are interested in getting involved, please contact us at info@casitacoalition.org. So without further delays, I would like to introduce our keynote speaker, Assemblymember Tim Grayson. Since November 2016, Assemblymember Tim Grayson has proudly represented the 14th Assembly District that includes portions of Contra Costa and Solana counties in the Bay Area. He has focused on issues related to addressing California's housing and transportation crisis, increasing our budget reserves and access to higher education, mitigating human trafficking, minimizing the risk of wildfires, and helping individuals with special needs. 17 of the bills Grayson authored in his first term were signed into law. Assemblymember Grayson serves as the chair on the Assembly Banking and Finance Committee, the Business and Professions Committee, the Insurance Committee, the Transportation Committee, and the Committee on Rules. He also chairs the Select Committee on Streamlining Services for Victims of Interpersonal Violence. A longtime East Bay resident, Assemblymember Grayson lives in Concord with his wife Tammy of more than 28 years and their children Joe and Cassie. Please welcome Assemblymember Tim Grayson.
Thank you. Thank you for that very, very kind introduction. Raphael, that was pretty awesome. I don't know if I can live up to all that stuff, but thank you very, very much. And what an honor it is today to be with such an esteemed group of professionals to discuss ADU financing. As a general contractor, still with an active license, and a former member of local government, housing has been really a huge focus of mine during my time in the legislature. It is simply too expensive to build housing in California, and part of that is due to extraordinarily high impact fees. Impact fees are really levied by local government to pay for the cost that a development's impact will have on local infrastructure, such as roads and sewer systems, and for special districts, water and other utilities. And again, I used to be in local government. I served as a council member, vice mayor, mayor in the city of Concord. So I truly do understand that in many cases, these impact fees are very necessary. And in a lot of cases, they're fair. But I've also been that developer on the other side, that builder on the other side of the counter pulling a permit. And sometimes these fees are so high that they raise the cost of housing so much that working families are completely priced out. And that development really doesn't pencil out, and it becomes financially infeasible. We see a lot of this in affordable housing projects. So I know from personal experience that the situation is even worse for ADUs. And believe it or not, in some cases, the cost of hooking up an ADU to public infrastructure is actually greater than the cost of the ADU itself. I know one particular case where 17,500 just to hook up electricity to the ADU. That was the impact fee. So for a working family just hoping to build an ADU for a relative or to generate some rental income, those high impact fees simply aren't workable. And that's why I authored AB 602 this year. AB 602 will create standards for the studies that local governments use to determine how high impact fees should be. It'll make impact fees proportional to the size of the unit, paving the way for more affordable, high-density housing solutions with smaller footprints, such as ADUs. In some cases, you would pay the exact same fee for an impact fee for a full-size single-family home that you would pay for a small AD unit in the backyard. So we've gotten it to the desk. The bill, AB 602, is on the governor's desk, and where it's really waiting on his signature. So if signed, the bill will drastically cut down the cost for homeowners installing an ADU. But unfortunately, impact fees are only just one part of the challenge when it comes to paying for an ADU. Simply put, really, our current financing options are not real well suited for ADUs. I'm not surprised to hear from stakeholders and advocates that mainstream financial institutions are slow to adapt to the increased demand for ADU financing options. For instance, housing finance, well, you know this, it's highly regulated, and the housing crisis remains seared in the memories of many financial leaders and regulators. So it's going to take some time for these institutions to tinker around and with the suite of lending options that we currently have. And let's talk about those options. Right now, to finance an ADU, you must use traditional lending products such as a home equity loan or a home equity line of credit, or which obviously has higher interest rates, or riskier options, which is borrowing from your retirement plan, completely circumventing consumer protections that are out there. So these options can work well in some situations, especially for those with significant equity in their homes, or for those who have accrued savings or wealth. And by the way, just to say, last year alone in my area, my district, housing prices or housing costs raised up to 25%, increased up to 25%, which means an inflated amount of home equity in some cases. So to borrow against that and then turn around and go through a dip would put some people in peril. So for many other homeowners, we're asking them really to fit a round peg into a square hole. For some, not all homeowners have the means or the equity to rely on that safer, more affordable financing option that's currently available. And so for many, the current suite of financial products we have now really don't consider the income of ADU that the ADU will generate for the homeowner. ADUs are not really yet common enough to give lenders certainty about what it actually does to the property's value. So clearly, there's work that needs to be done here, and it's really important that we move forward on this issue. And I'd like to continue to work with you and to hear from you, to learn. My office is open, and I really count it a privilege to be able to speak to you today. So thank you very, very much, and look forward to hearing other comments.
Thank you, Assemblymember Grayson, for that thoughtful and insightful introduction to the topic for today's webinar, as well as for your leadership in Sacramento in expanding the number of affordable home options for all Californians. Good morning, everyone. My name is Caleb Smith. It's my pleasure to be the co-chair for the Casita Coalition's ADU Finance Work Group, along with Rafael Perez. And in my normal job, I am an analyst working on affordable housing for the County of San Mateo. It's great to be here with you all today. I know we're looking forward to hearing about some of the most exciting work that's already out there on accessory dwelling unit finance, as well as learning more about some of the challenges that we're continuing to work through. It is my very great pleasure to introduce our first guest speaker from our ADU expert groups for ADU finance. That is Sharyl Silva, a loan production supervisor for single family lending for the California Housing Finance Agency, or CalHFA. We're very grateful to have her here today with us to talk about a very exciting grant program that is one of the biggest developments in ADU finance in recent memory. And I'm going to now turn it over to you, Sharyl.
Thank you, Caleb. Hello, everyone. I'm Sharyl Silva from CalHFA, and I'm super excited to share our newest program with you. It's an ADU grant program. We have been trying to figure out a way to assist in building ADU units, and we had to think way outside the box and do something we've never done before, but I think we have a pretty good solution. And it will give up to $25,000 in the form of a grant to help with pre-development costs. So pre-development costs can be, the impact fees, permit, soil test, architect designs, all of the stuff that has to happen before you can actually build the ADU to get the site ready. We will help anyone that meets certain criteria. So there's 3 different qualifications. If they meet one of those 3 qualifications, then they can use our program. So the first thing is they have to be 80% AMI or less, so low income. Our targets for this program are people of low income, people of low equity, and people who are in qualified census tracts. So the first one is if they're 80% or less area median income. Now, I understand that that's low. Especially to build an ADU, to find a borrower that is within that income limit is going to be low. So that's just one of the criteria. Another criteria is they have to be under CalHFA's income limits, which are considerably higher, so 150% AMI. And they have to have a combined loan to value greater than 80%. So not less than, greater than 80%. So most people who are doing a renovation construction loan for an ADU are definitely going to be greater than 80% CLTV. So we assume that that's probably the bucket that we're going to get the most traction in. Just for an example of our income limits, for Sacramento County, our income limit is $180,000. So they'd have to make less than $180,000. For LA County, it's $158,000. For Alameda County, it's $248,000. Okay, so that's much more doable, the income limit, as long as they just aren't sitting on a whole bunch of equity. The other way they could qualify is they could be under the CalHFA income limit and be in a qualified census tract. So there's the 3 different ways that they can qualify for the program. Now, the $25,000, it's up to $25,000 depending on how many pre-development costs they have. If they only have $20,000 in pre-development costs, then they can only get a grant for $20,000. But how it'll work is when the lender is doing their renovation or construction loan, we are going to deposit the money directly into the construction escrow account. Okay, so normally borrowers finance all of these fees, right? They're not going to have this money to just pay up front out of pocket. So they're financing those fees in the construction or renovation loan. And CalHFA is going to contribute this grant to that construction and renovation loan. So the up to $25,000 is going to go directly into the escrow account to help pay for all of those fees. Right now, we have 6 lenders that have signed up. The program just went live September 20th, so we're excited that we already have 6 lenders signed up. Right now, it's Castle and Cook, DAS Acquisition, JMJ Financial, Land Home Financial, Nations Reliable, and Synergy One Lending. So those are the ones that are currently offering the ADU grant program. I've spoken to several of them, and they have like a pipeline of these loans that maybe they've had to decline, or they're waiting because they had an appraisal and it came in kind of low. There's issues with the appraisals, obviously, because it's like a newer thing and trying to make sure you get the right value. This program can help with those situations. So if you have a borrower that maybe the appraisal came in 20 grand low and you're trying to do a 95% renovation loan, you can now factor in our 25,000 grant to get them to the 95%, even if their appraisal came in a little short. So if you have people in your pipeline that maybe you couldn't do the renovation loan because it was off by a little bit of money, they may now qualify because of the grant program. We're also working, diligently with all of the local government agencies This is a grant, so it can get combined with any of those programs. So, a city or a county might have an ADU program where they're offering some financing. Ours can go along with that. The cities and counties may have like cheaper permits if you're picking, from their ADUs that they have already approved and things like that. That can help with that too. So we're trying to combine as many resources as possible to make it as affordable as possible for these borrowers. Now, they're doing a renovation loan, which is a little bit more of an expensive loan, obviously. But Fannie Mae has also come into the mix, and they're working on doing some variances so that you can refinance these borrowers after the renovation loan is complete and the ADU has been built. And these will be more affordable loans. Obviously, they'll just be a regular refinance. It's not going to be a renovation loan or a cash out or anything like that. So all of these parties are working together. We're trying to make the whole process work as best as we can. The program started on the 20th, so we are accepting new reservations, but we're going to do our official launch and press release in the next couple of weeks. I know the governor is going to be a part of a lot of that, so just stay tuned. You're probably going to see a lot of it in the news, articles and things like that coming up soon. And then I think that's it. If anybody has any questions, I believe we're doing a Q&A. But thank you so much for your time, and I hope you are as excited about this program as I am.
Thank you, Sharyl. I think we all are as excited as you are about this program. So as Sharyl said, there is a Q&A function. You can find that at the bottom of your screen. You can use that to submit questions. Sharyl will be staying on for the full duration of our webinar. We have some dedicated time set for Q&A live. That's going to be after we hear from our other panelists today. However, you don't have to wait to fill out a question in the Q&A function. You can also upvote questions that others have asked if you want to make sure that we see them at the top of our queue to answer them live today. Some of our panelists will also be typing in answers. So if you go to the Answered tab in the Q&A, you can also see what has already been asked and answered. So thank you, Sharyl. That's very exciting news. So we're also going to want to talk about a few other news developments in accessory dwelling unit finance. One of them is actually a funding opportunity for local governments and nonprofits that recently came up. So this is a notice of funding availability for a program that the California Department of Housing and Community Development runs called CalHome. Under this program, local governments, nonprofits, or local governments and nonprofits partnering together can apply for state funding for a variety of purposes. But one possible use of interest to us today is to create a local ADU and or JADU lending program for low-income homeowners. Each jurisdiction or nonprofit can apply for up to $5 million through this program. However, each ADU loan would be capped at $100,000 because the idea is that these loans would be gap financing. Now, the applications for this notice of funding availability are due on November 22nd, and you can visit hcd.ca.gov for more information and details about experience requirements, scoring, and the amount of money that's available. There's maybe in the neighborhood of $37 million that isn't specifically reserved in this notice of funding availability, but there are some other purposes besides ADUs that it can be used for. So it's still good to take a look at that notice of funding availability if you're interested in creating a local ADU lending program. Now, we're going to dive into hearing from some of our panelists in a little bit, people who are on the front lines of helping homeowners finance their accessory dwelling unit projects. But before we did so, wanted to talk a little bit about some of the key challenges that we're facing accessory dwelling unit finance in California, as well as a few of the ways that local governments can help address those challenges, because I know we have some local governments on this webinar today. Now, I was recently going back through a report that the Turner Center at UC Berkeley put out last year. And whenever I look over that report on accessory dwelling unit finance in California, my eyes are always drawn back to this table. And this table really shows at some of the disparities that we've seen in terms of where accessory dwelling units have been built in California. As you can see in this chart, if you were to compare two census tracts, one from the highest quarter of incomes in California, one from the lowest quarter of incomes in California, you can see that the higher income census tract would be likely to have 50% more ADU completions than the lower income census tract. So when we're talking about ADU finance, it's really a key equity challenge, because people in many respects who would benefit the most from the benefits of accessory dwelling units as a way to affordably house family, as a way to build home equity, and as an extra source of income to help pay for a mortgage or cover household expenses, are the people who are not able to build accessory dwelling units the same rate as other Californians. So we're seeing that in many cases, finance is one of the key reasons why this disparity has opened up. Now, in terms of why we're seeing this disparity, Assemblymember Grayson did a great job in covering some of them earlier. But once again, some of the key challenges are around the counting of future income. What we're seeing is that if you're a financial institution, you want to sell your loan on the secondary market, most financial institutions do, so they can keep turning over the money. You are not able to take into account the future income from ADUs when you're writing a loan. And that means that low-income families, as well as a lot of retirees on fixed incomes, are unable to access traditional lending because they have trouble reaching the debt-to-income ratio. That's the maximum allowed for those loans that get resold. We're also seeing that appraisals are sometimes a challenge for ADUs if you're trying to use the future value of an ADU to help qualify for a loan. ADUs, legal ADUs to be specific, are a little bit of a new thing in most of California. So we're seeing that appraisers are still getting a better understanding of how to appraise them. And we're also seeing that data quality issues sometimes make it hard for appraisers. Appraisers ideally want to find two houses, one with an ADU and one without, when they're trying to figure out that have sold recently, when they're trying to do appraisals. But the fact right now is that the multiple listing service, which captures a lot of information on home sales, doesn't do a good job in tracking ADUs. So that makes it harder for appraisers. So ADUs are also sometimes difficult to appraise when we're talking about JADUs or internal ADUs, some of the most inexpensive options for building an ADU. However, they often add less to home value, which makes them a special financing challenge. So I want to then pivot a little bit to say, if you're a local government and you want to help your homeowners, what can you do? Well, there's a few different options. A lot of it really comes down to information. If you are trying to help your homeowners apply for ADU loans, making the information on ADU permit fees easy to understand and easy to find can help make sure that your homeowners can put together a good loan packet so they can qualify for loans more easily. You may consider hosting vendor fairs with several different lenders, as well as potentially other ADU professionals, to make it easier for your homeowners to find the right option for their project. You can't naturally endorse specific lenders, but just making it easier to comparison shop can be of enormous help to homeowners. And finally, many of you may have connections with local financial institutions. We've seen that some lenders are really going out and being adventurous, credit unions and such, in sometimes having programs that are better fit for ADUs that they're willing to hold on their portfolio and not do on secondary markets. If you can provide local financial institutions with evidence that ADUs are a popular option in your community, then you make it more likely that more lenders will hop in to create more ADU-friendly products. So that's just a little bit of the thoughts I wanted to share with you today. But I now wanted to turn it over to our panel of ADU experts, the people at the front lines who are seeing firsthand what's working and what's not working in the world of ADU finance in California. So I'm now going to turn it over to our first from our panelists. That's going to be Lindsay Moon from Searchlight Lending, based here in the San Francisco Bay Area. And she's going to share with us a little bit more about the advantages and limitations of some traditional refinancing options. Over to you, Lindsay.
Thank you, Caleb. Hi, everyone. Happy Friday. I'm going to share my screen here. All right. So advantages and limitations of refinancing. Yes, I'm Lindsay Moon. I am a licensed independent mortgage broker with Searchlight Lending, and I'm also a prefab builder. All in all, hang on a second. There we go. rates are great and they are historically low. So it is a good time to borrow money if you can and make home improvements. The two ways that I'm going to cover today are cash out refinance and a home equity line of credit, and a couple of out-of-the-box solutions as well. But for a cash out refinance, you know, it is the best and least expensive way to find financing for an ADU project. But you do need to have the equity for the project, and utilizing your home's equity to build equity is a really sound investment. And the return on your investment, or ROI, is it tends to either be immediate or within just a few years for most people. Some of the pros and cons are, as I said, it does tend to be the least expensive option. You do fund in one lump sum and it's yours to use how you want throughout the course of your project. And it tends to be usually a relatively easy process compared to some other alternatives. Rates can be both fixed or adjustable. Some cons are that you're paying your interest immediately upon receiving your funds, and you're also increasing your monthly mortgage payment. Going into a line of credit or a HELOC, home equity line of credit, it's another alternative, but it also requires equity in your home. It's a line of credit that's issued to you against your equity, so you can borrow against it when you want to. It's also a great potential for, you know, if you were doing a cash out refinance, you may not pull out enough, whereas sometimes a line might be issued for more than what you need. So, you know, pros are you're paying interest once you start drawing, not immediately upon receiving any funds. You're just issued a line. And again, it can be helpful if you're unsure of your budget. Some cons of it, though, are the term can be shorter. It's definitely an adjustable rate and a little bit higher of a rate. And depending on your term, it can become due relatively quickly and due in full, and that can surprise a lot of homeowners. And just a couple of other alternatives to think about, and this is a little bit of a plug for being an independent mortgage broker, is that, you know, I do loans both in the box and out of the box. I also do private money loans. So if you have multiple properties that have collateral in them, or you want to cross collateralize a property, private money is an option. It's a little bit higher, but you can also potentially refinance again once the construction is completed. There's also, you know, what we call non-QM or non-conventional cash out refinance loans available out there, like bank statement loans or loans for investment properties. There's something called a DSCR loan, which is based upon the income that that property generates, not based upon your income. And we also actually have a no-doc program, which is great for people that may be unemployed at the moment, but have good credit and some equity and some reserves. And so just a lot of things that an independent can segue to if, you know, maybe the traditional way of doing a cash out refinance may not work. And thank you very much. That's how you can reach me. And thank you for this opportunity. Oh, and I'll stop sharing. I'm sorry.
All good. Thank you, Lindsay. We appreciate hearing a little bit more about all that.
Thanks, Caleb.
Our next panelist is Lourdes Hernandez from Loan Depot in the San Diego area, also a proud veteran. Lourdes will be covering renovation loans to build an ADU, another very popular strategy that we're seeing here in California. Over to you, Lourdes.
Hello, everyone. Like Caleb said, my name is Lourdes, and I am a loan consultant with Loan Depot, specializing in the renovation programs. And I'll start sharing here some screenshots so that we could follow through. So renovation loans are great and are being used more and more now to build ADUs. Now, some of the advantages of using the renovation loans, they are supported by Fannie Mae and they are supported by FHA. And let me get over here, go to the next slide. My mouse doesn't want to work. Sorry about that, guys. So it does help in increasing that square footage, whether you're looking for a granny flat to support extended family members, or if you want to go ahead and look for rental income, future rental income. A lot of ADUs are being rented out, and these programs can support it. Now, what I wanted to go through is give you a little bit of insight as to how the loans work on the financing side or on the renovation side. And of course, we start having technical difficulties right when we're live. So excuse me here. So why should buyers consider renovation financing? Well, there are several reasons as to why. It's the opportunity to use projected income or projected value once that renovation has been completed. Not a lot of programs can support that. It gets you the availability, or it gives you the availability to purchase a home in more desirable area. Maybe you are not able to purchase in an area that already has 2 homes, but you can purchase in an area that has 1, less expensive, and then have the ability to build that ADU to fit your needs. This is a brief example as to how the renovation program works. You do finance all into one. You finance, whether it's the purchase in this instance or in this example, it's the purchase of a home plus the renovation, and then you do the acquisition price, and that's what we finance. The renovation is all included into one loan, and you do have the ability to put it into a renovation account and therefore support that CalHFA program, as that's one of those requirements that they need. The loan benefits of the renovation program is you could use it for a purchase or a refinance. If you already have the home and your family is growing, you want that extra living space, you could go ahead and support that through a refinance as well and finance that ADU into one loan. You build immediate equity as soon as that project is complete. The whole amount is interest deduction on your property taxes at the end as well. And it's the ability to match or create a home that matches the buyer's taste and lifestyle. Now, the renovation program is supported only by Fannie Mae and FHA, and they are full doc programs. Now, VA renovation does exist. It doesn't quite support an ADU, but it does allow you to extend within the financing of the loan, extend the square footage, add extra bedrooms, extra bathroom, maybe a laundry room that can later on at the homeowner's cost be converted into a kitchen. So it doesn't quite allow an ADU, but it does allow you to extend the home for a future ADU conversion if needed. Now, certain guidelines are minimum down payments. For FHA, it's still 3.5% based on the full acquisition price. It has to be on a 1-unit primary residence, and it does have to be attached to the property is the only feature that FHA has, different than the Fannie Mae. The Fannie Mae does allow for a 3% or a 5% down on a purchase, and it does allow for the ADU to be detached. So those are some guidelines. 203, a difference between the 203K and the Fannie Mae home style. Both again support ADU financing, regular debt to income ratios that Fannie Mae and FHA allow. So all of the guidelines remain the same. It's just the end process or the funding process at the end is a little different. But we take care of that on our end, simplifying it for the new homeowner. Any other questions? Yeah, I'll stay on for the Q&A portion as well.
Thank you, Lourdes. And yes, people can ask questions in the Q&A at the bottom of your screen. We'll be doing that a little bit later on. But first, we're going to hear from some more panelists. And I'm pleased to introduce our next panelist, who is Meredith Stowers from the Stowers team at CrossCountry Mortgage. She's going to be diving into a little bit more of the details in terms of what people should know about renovation financing and how it might apply to ADUs. You're on mute.
There we go. So we've talked about there are multiple options. There's cash out. There is a second mortgage, although those tend to be higher interest rates, don't have the deductibility. And then, as Lourdes discussed, it's renovation loan, which is a type of refinance based on future appraised value. Quite literally, we send the appraiser out with the pretty designs and permits, and he says, oh, I see what you're going to build. Instead of your home being worth the current value, it's going to be based on this future value. And there is a timeline that experienced lenders will handhold their clients through, and contractors as well, to go through this. Now, how do you know, let's just see, how do you know that a renovation loan is right for you? Well, quite simply, if you look at the left side, that is an example of a cash out. Lenders can typically only cash out up to 80%. So in this case, you would only get 110% of value. But when you add to a renovation loan, you can see how much more of a construction budget is available to that. I had the great pleasure of testifying before the Federal Housing Finance Authority, along with several other of my colleagues here, Caleb and Raphael. And we believe that these guidelines are going to be expanded nationwide to make ADUs even more accessible, but renovation lending is key. Most lenders, you're looking at some of the top experts in California, most lenders do not do renovation lending. So it's super important to partner with those, because otherwise a typical bank will simply say, oh, you're not qualified. I didn't even know of a loan for this, when in fact renovation lending is available. We're going to talk about this in a second. So when we go into the renovation lending, one of the benefits too is because the budgets can be so much bigger and better, you can also take a look at doing long-term strategies. I have a number of retirees that we work with where they've lived in the house forever. They want to move into the ADU, but they need to and rent the primary home, but they need to fix it up. They need that 50-year roof. They need to, do some updates and stuff like that. So there's a lot of good things that renovation lending can also cover. What's key about renovation lending that's different from a traditional refinance is the consumer protections. We are required by the government agencies to use what's called a HUD consultant or a HUD inspector. This is a home inspector who's specially certified by the Department of Housing and Urban Development. He's the one who oversees construction with the homeowner, and he makes sure that the construction's done right, that the contractor's living up to his work, that is permittable, and so on. And he's the one who authorizes payment on construction as it goes. So consumers really are greatly protected by this loan. And there tends to be a process. We generally speaking see an entire year of this process. First of all, in the first 2 months, we like to get you pre-approved and you start designs. Pre-approval is kind of important because you need to know what your budgets are, what you're qualified worth. The worst thing a client can do is try to ham and egg it with retirement savings here and a cash out there and whatever. You need to know where 100% of your funds are, and a good lender will walk you through that. Designs typically take 2 months. And when you submit for designs, that's when we want to start the loan process. That's when you're going to meet the HUD consultant. He's going to come out to the property. We require the HUD consultant and the contractor to meet together, work out a scheduled payment, go over the property, and so on. And then we launch the loan. That's when we order the appraisal. When we get the appraisal back, we have to huddle up with the contractor and the HUD consultant to revise those numbers, tighten things up, submit for underwriting and approval. And we try to plan to close the loan when you need the funds for construction. Because otherwise, if you start at the beginning here, you're paying extra on your mortgage through the whole process. So we really work collaboratively to do that. Where am I here? Okay. So there's 2 costs involved with this. One is that initial HUD consultant is a $2,000 cost. And that's because you've got to put together a ton of paperwork. That is reimbursable when the loan funds. The designs and permits are also reimbursable when the loan funds as part of the loan. Now that adds to your mortgage, and that's where CalHFA can be a tremendous help, and other grants like that. The other fee is the $1,200 appraisal. These are specially trained construction appraisers, and that unfortunately is not reimbursable. But honestly, if that is your only cost out of pocket on this loan, ultimately, this is a great value to consumers. And we also want to make sure that you have the best interest rate at the right time. So we deliberately try to close at the beginning of any given month so you have no mortgage payment for 2 months, and you're going to pay that to savings. And we really guide our clients through that. So now come month 3, you've got your first mortgage payment. You're going to take that little bit extra out from savings until construction is done and the renter is in. And finally, if there is a case where, in some cases, for example, the Fannie Mae products are a little bit of a higher interest rate, we'll provide a complimentary rate and term refinance. So we do 100% financing on the construction, and we finally get that rate lower for your forever home loan. So it is a complicated process, and there are certainly challenges, and the guidelines are changing in a head-spinning way, but in a good way, to be able to build more payment, to be able to fix this. We're going to see a lot more manufactured ADUs and so on. But what's most important is 2 mistakes I see people make, huge mistakes. One, they don't plan their financing, and they try to ham and egg it. And that's a great way to end up with no retirement savings. But number 2, work with an experienced collaborative team, and beware of low bids. We see bids all day long across our desk, and we know what the difference between experience and not. But we can help you. We can help you at the cities. So these are some of the more details on us. We can help you, the cities, by partnering with you to create educational seminars to guide people through this. This is a lot of information, and it's important that people see and hear this all the time and get proper guidance to get their ADU financed. But it is available and it is doable. Caleb?
Thank you, Meredith. I'm sure we all appreciated learning a little bit more about the intricacies of renovation lending. Plus, certainly something that I didn't know a whole lot about before I started getting involved in the ADU space. So once again, you can go into the Q&A to ask questions. We will be answering some of these live later on. Also, I see a few questions that have come up multiple times. The passcode for today's webinar is 0924, and a copy of the recording for this webinar will be posted on the Casita Coalition's YouTube page sometime next week. Now, it's my very great pleasure to turn it over to our final panelist before we go into our Q&A section. Our final panelist is Susan Brown. She recently joined CoreSGB in Oregon and is very knowledgeable about construction finance nationally, and will share some unconventional strategies for financing from around the country for accessory dwelling units and missing middle housing. So over to you, Susan.
Thanks a lot, Caleb, and thanks for the opportunity to be here with everybody today. It's a beautiful Friday up here in Portland, Oregon, which is where I reside. So welcome and thanks for joining in. Hopefully you're able to see my slides there. Those should pop up in a moment. My background is 42 years in financial services. Most recently, I developed a program for a regional bank and ran their residential construction lending program, where we did in excess of $5 billion worth of financing over the last 7 years, helped about 10,000 families with their projects, including ADUs and manufactureds. What I'd like to talk about today is financing outside of those conventional methods that were covered by the prior panelists. As we attempt to help customers or homeowners finance these projects, as it was mentioned in the early comments by the Assemblyman, it can be difficult to find financing for many people. So I want to talk just a little bit about some things outside of the traditional financing methods. Let's see here really quick. There we go. All right. So outside of traditional financing, there is a wide swath of financing available, which is kind of not well known to most people. Lindsay talked about it in her comments being in the private space, and I'll talk about that in a little bit more detail. It's people who have access to capital in a variety of different ways and can make funds available to builders and developers and property owners who are looking primarily at developing non-owner occupied or investment type properties. Also spec lending, where a property is being acquired, renovated or built, and then sold after completion. The sources available can range anywhere from cash, taking from retirement savings, borrowing from a relative, lines of credit, those we talked about a little bit before. There are also instruments called a guidance line, which helps finance a builder for a specific project, and those funds can be dispersed as that project advances. Construction loans are another option that was touched on nicely by our prior panelists. Those construction loans are specifically for that project that take into account all the documentation about the project and are dispersed as the construction moves forward. And then into more of my topic about the private market-driven funds and social impact investing. These tend to be anywhere from very, very small groups of people who might be one or two people who have combined their funds to loan for projects, to individuals, to builders or developers, ranging from small amounts to very large amounts. I've talked with investors who have very large pools of money, up to several $100 million that they have available to rotate, all the way down to projects as small as $100,000. Another recent development are social impact funds, which are groups of people who have a very specific goal to help with a very specific cause. It could be health and welfare. In our case, it's people who are wanting to help finance for either low and moderate income individuals or new developing areas such as ADUs and middle market. The funds that they have available for duplex, triplex, and fourplex, and also multiple ADUs. The types of financing that were talked about previously are typically available for a single ADU on a lot. The GSEs, Fannie, Freddie, FHA, generally only have an appetite for one ADU, but these specialty private funds are able to accommodate multiple ADUs, and also cottage clusters, which are becoming a lot more popular, at least here in the Northwest. Generally, these projects are available for non-owner occupied properties, meaning the person who is developing the project is not the person who will be living there. Like I mentioned, loan amounts anywhere from $100,000 all the way up to $2.5 million, depending on the complexity of the project and the experience of the person who is developing that property. These funds are wealthy individuals, private equity funds, which are generally multiple people who have brought their funds together, and private equity funds, wealth funds, and hedge funds. And interestingly, these processes are not as onerous from a documentation standpoint as the conventional programs are that require full documentation. And in some cases, the lending decision is made within a 24-hour period of time by the individual who holds the money to decide if they would like to loan those funds or not. So it's incredibly flexible. There's also some downsides to that I won't get into a lot of detail about here, but would be happy to discuss those with anybody who's interested. This chart attempts to just very briefly describe conventional sources of funds and non-conventional or unconventional funds, what the products are, what the funds are, and where those funds come from. People like Lindsay at the top of the panelists and myself are able to help people find these sources of funds. It's almost like you need to know somebody who is involved in this space. So please feel free to reach out to Lindsay or myself, we'd be happy to talk in more detail about that. I also want to briefly talk about some work that's happening in locally as well as on the national stage. In Oregon, our legislative session this year passed Senate Bill 458, which allows for up to 4 subdivisions of a single family lot. And California SB 9 was just signed by Governor Newsom, I believe late last week or early this week. Forgive me for not knowing the exact time frame, but that allows for the subdivision of lots in California as well. Because of those new zoning opportunities, financing is going to need to move forward. And it's my estimation that as more of these projects come to the fore and more private financing has been used to accommodate those projects, ultimately, those lenders who have been very shy to jump back into this space will recognize that there are tremendous opportunities for business models that can be very profitable for those institutions. So I think over time, as the demand increases and we're able to see the performance of those loans for these properties, I believe that the more traditional secondary markets, capital markets will come back into play. That is the end of my comments. Caleb, I'll hand it back to you and happy to stay on for the rest of the presentation.
Awesome. Thank you, Susan. Much appreciated. It's great to get that broader perspective beyond California. I know that we're at the cutting edge of a lot of stuff, but we don't have a monopoly on good ideas here. So I'm now going to turn it back over to my co-chair for the ADU Finance Work Group, who's going to help facilitate the question and answer segment for today's presentation.
Thank you, Caleb. And thank you very much, Susan, and to all our presenters this morning. If you have any questions, please ask your questions by clicking on the Q&A button at the bottom of your screen. The attendees, that the rest of you have the ability to upvote questions, give them higher priority ranking. If we're able to answer the question live, the panelists can go in there and type in an answer. And we can also do so in the moment. Our panel of experts are available to have a discussion about questions that have come up in the Q&A. So I've gone through and looked at some to get us started, and feel free to put any additional ones into the Q&A feature. So go ahead and get started. And I'll just go in the order of presenters. I've kind of come up with one for each, and then we can go and take a glance again at the ones that have been upvoted or submitted since. So the first one was for Sharyl at CalHFA. One of the questions asked about the reimbursement of soft costs. I know in the example, we talked about how those soft costs can be funded into the renovation. People asked about reimbursement, if they've already spent the money on those soft costs, if those are reimbursable as well. And then also there was a question about combining this with local assistance programs. And then if you could just clarify if that has to be through a renovation loan or a loan with a renovation escrow. So I'll let you answer that question.
Sure, thank you. So yes, if you are paying the soft costs out of your own pocket and not included in the loan, you can use our grant for reimbursement of that, absolutely. We do, combine with all the city and county programs. If a county has a loan program or a renovation loan that we're combining with, we just have to make sure it's the same lender that's approved with both of us. So as long as the lender is approved for both of our programs, then you're good to go, because one lender would do the whole transaction. You couldn't do like one lender for one part and one lender for another part.
Perfect. And then the lender does have to have a renovation escrow, whether or not it's a renovation loan.
Correct. Yes. So we've been very careful not to say what type of loan works, because different lenders call it different things, but it needs to have a escrow mechanism that we can deposit the funds in, and that the lender is overseeing that escrow account and dispersing the funds and making sure the ADU is done. So like a regular cash out refinance where the borrower is just getting the money and then they're building the ADU on their own would not work. It would have to be in an account that's monitored by the lender, where the lender is dispersing the funds and making sure everything's completed.
Great, thank you for that clarification. I'm sure it was of much value to our attendees who had questions. Moving on, the next question is for Lourdes. There was a question about, and also for Lindsay as well, because I think both of the products that were discussed could cover this. So the question is financing available to legalize unpermitted ADUs?
It is the program can go ahead and facilitate bringing that ADU into permits and, you know, acquiring what's needed and fixing what's needed in order for them to become permitted ADUs. Yes.
Okay, thank you. And obviously that's assuming that the consultant has verified that it is permittable.
Of course, of course. So all the regular guidelines will still be applicable. A HUD consultant will still be needed. And it, for that specific purpose, is to make sure that, you know, setbacks and things like that are still supported by the ADU that's there already. If not, the revisions and whatever is needed to correct anything that isn't approvable can be financed into that renovation loan.
Great, thank you. Lindsay, do you have anything to add to that?
Yeah, well, just with regards to pulling cash out, you certainly have the flexibility of using that money towards anything you see fit. So yeah, it absolutely is a great way to do that. Either by HELOC or by a cash out refi.
Great, thank you. And some of the non-renovation private options would probably have the ability to do the escrow construction need in order to be eligible for that CalHFA money, right?
Well, private money is also pretty flexible. There's rarely any sort of escrow account. But I do have a kind of a small time lender that does a kind of a construction type loan that is just their own product. And there are several other products out there. So that's potentially an option. It just would depend on the lender.
Right. So ultimately, there's a broad range of products that could be paired with the CalHFA, and it's up to everybody to meet with experienced lenders to analyze what's best for them. But I appreciate everybody's answers there. The next question is for Meredith. There was a question about a future appraised value, and some of the attendees were confused as to how a lender has to use comparable sales, and yet this doesn't exist. So how do they come in and factor future appraised value on something that doesn't exist? Obviously, that's a component of the renovation loan, and appraisers need to be versed in that. If you could elaborate on how that works for appraised value on future value.
Absolutely. So it is a real challenge because currently those appraisal guidelines are from the 1950s. And it's one of the things that Federal Housing Finance Authority is looking at changing and just, you know, calling a duck and treating ADUs as rental properties. If that change happens, as we believe it will, then it's very simple. You can treat a single family home with an ADU as an equivalent to a duplex, you know, in the same neighborhood. Right now, we did two things to solve this issue. And this is, again, why it's important to work with ADU specialist renovation lenders. We partnered with the Appraisal Institute and got all of our appraisal panels trained. And then the appraisal panels are set aside renovation appraisers so that only those appraisers can go work on ADUs. That substantially increased the value, because if you work with, forgive the terminology, a junior woodchuck appraiser who's just off some lead gen system, they'll give it typically zero value, which is crazy. I just had that happen, and for a $250,000, you know, gorgeous, modern, you know, spacious ADU, and they gave it zero value. Well, come on. So we did fight the appraisal and win on that. Typically, we get 75% of future value, 75% to 110%. But that's where the refinance afterward really helps, because once something's built, the appraiser can really actually physically see it. There's tangible rental income, whatever, and that's when we get full value per construction money or more. So we've all worked pretty hard on this, but I think that's made a huge difference.
Right, and I think another component that's really helpful in working with an experienced team is an experienced renovation lender is going to make sure to scrub the contractor's bid so that it truly tells the story of what's actually getting built, and they don't underestimate the final product, so that the appraiser has that narrative. Is that correct?
Oh, it's absolutely true. I think we've all here have gotten, contractor submissions on a paper napkin, on a cocktail napkin that's like, I will build kitchen with flooring. Well, and we lenders, it's important, at flooring, is that Italian marble tile or is that Home Depot vinyl laminate, whatever. So the HUD inspectors, this is where this really protects consumers, because between us and the HUD inspectors, we make them detail it out. And we flat out tell people, we're not working with you. We don't trust you to get it done. And that's a good thing for consumers.
Great, thank you for that, Meredith. All right, the next question is for Susan. And this, and any other of our panelists, feel free to jump in if you want to take a stab at this one. But the question, Susan, is the lending world ready for SB 9 and 10?
Oh, oh boy. It's Friday. Let's get a case of wine and talk about that. I'm going to say, frankly, it's not ready yet. But many times fabulous ideas have to percolate. They have to be proven before mainstream resources are put towards the projects. Where I'm inspired is that there are many, many small resources available today. If we can collaboratively leverage those resources and prove that these housing models work, and that most importantly, the loans against these properties will perform in a way that isn't too risky for the lending entity, more capital will flow into the market, which will by definition drive the interest rates down a little bit and create a more competitive marketplace. It will happen. These housing types are not unknown. They're just new again. In the day when duplex, triplex, fourplex were built all the time, people have been building ADUs for years, just not on a permitted basis. But now that we've got the rules that are allowing these things to be done legally, eventually the money will flow. So I would just ask people, don't get discouraged. Call people like the panelists today, and we can help you find sources of funds that can help you get your project done.
Great. And I'm going to ask a follow-up question to the whole panel to see if anybody, I'm just thinking on the fly, and I would like to get your feedback if this is something with feasibility. So SB 9 allows, starting January 1st, the ability to split a lot as long as it's at least 40% of the existing lot size. Could, using the existing group of programs, could a Frankenstein approach be put together to facilitate this, right? So in theory, could a renovation loan be used to develop a secondary unit in the backyard of somebody's property, and then a future refinance to split it and create a new loan for each of the two newly split parcels that would be split with a second escrow? So essentially you have to use 3 total loans to complete SB 9. That's why I call it the Frankenstein approach. It's not streamlined, it's not easy, but it makes it possible. Is that something that sounds like it could work? And I'll just throw it out to the whole panel to give your opinion.
I have a couple clients that are doing that right now. And what's exciting to me is that you're absolutely right, Raphael, like that's not happening in like an urban city center, but it is happening in, kind of the edges of suburbia where it used to be farmland and there's these huge lots. I have one client that has a huge lot in like Vista, California, right on the suburban edge. And they're going to build an ADU in the corner of the lot, split the lot, and then they're going to build an ADU and an ADU, and that they're actually probably going to have family members live there and own it all together. So I see a lot of these family compounds as well. So I think that's a great thing.
Yeah, definitely seeing the conversational multi-generational housing bubble up as a result of some of these new changes. Does anybody else want to?
I'd like to add just a little bit more to Meredith's comments, if I may. And Caleb, I see you raising your hand, so maybe I should defer to you until you've spoken.
You go first.
Oh, thank you. One of the intricacies, and I think the Frankenstein approach that you were referring to, Raphael, is how do the current lenders view the subdivisions of those lots? And it does get interesting as you subdivide. You do need consent from any lien holders on the property to be able to accomplish that. The other part of that is when people look at developing an ADU, they have to follow the guidelines for ADU development within that jurisdiction. Some of them require that ADU to be built, let's say, within 30 feet of the main home. So every situation is going to be a little bit different. It's not for the faint of heart, but it is possible on a step-by-step incremental basis in many cases.
So you're saying that cities need to consider this when analyzing their policies.
That might be what I'm saying. Thank you.
Thank you. And any other comment from our other panelists?
Yeah,
and then we can let Caleb jump in. Caleb?
Yeah, well, I think I'd actually kind of build on Susan's point. I think one of the big questions is that one of the provisions I know some ADU builders were particularly interested in with regards to SB 9 was the part that it allowed for a 60-40 division of lot splits, and that lot split can be as little as 1,200 feet in each of the remaining parcels. Now, I think one of the really interesting questions is, does this mean we're going to see more flag lots? That is, a lot where you carve out the backyard and the driveway into a separate lot, and then the existing home sort of sits on its own lot. Because if you are able to do flag lots, then assuming the existing home is small enough that you actually can play around with this by carving off a big enough portion of the backyard, we may see some urban areas where using a flag lot and then separating off the backyard into a separate parcel might be a financing strategy for what is right now considered a detached ADU. Because if you're only interested in building one additional unit, which is probably going to be the case for most homeowners who are trying to build on, a 5,000 to 7,000 square foot lot, then if you're trying to build one unit and you can carve it off into a separate lot, then you're looking at traditional home building financing for building a new house. And that's a lot simpler than a lot of the existing options for building an ADU. But then really the question, and this is something that's a good question for all of the local government staff who are on the call today, is what is the city going to do about things like street frontage and access requirements? Because those kinds of local decisions could be very impactful in terms of how many new flag lots we're seeing in California due to SB 9. So as Susan was saying, there's a lot of local considerations which can have some rather substantial financial impacts for these housing types, the small detached cottages.
And thanks for adding that to the conversation, Caleb. Is there any further comments from our panelists? I'm going to check the Q&A to see if there's any outstanding questions.
I think we all agree the most important thing that cities can do is raise awareness on the loan options, so people know that they can do it, even if they don't have equity, even if they're where there's a will, there's a way and there's a loan option. So by hosting local events, we're, for example, joining the Del Mar Home Fair, which has 13,000 people in San Diego, or the county and the city of San Diego are coming to that and promoting it. There's other events. The county of San Diego has done a number of events on ADUs, particularly for seniors, in partnership with AARP. There's a lot of good options that we can all support you on so that quality information gets out.
Yeah, and to follow up on that, I would add, for any of you participants in the audience who may be lenders, I would encourage you to reach out to your local association of realtors. They all have a government affairs wing, and you can partner and work together to get this information out to your local city. to make sure as things are considered moving forward, that there's proper consideration to maximize the impact and the homeownership opportunity that a lot of this stuff can create. So also would encourage you to reach out and partner up with local nonprofits, local realtor associations, local businesses, and really create collaboration so that you come with a unified voice to your local municipalities, and try to really educate the community. Well, I don't see any further questions. If our panelists,
I do.
Caleb?
Yes, I did see a question about I did see one or two questions that people typed in answers, but I think it'd be good to pull in the panel on. And I also saw there was recently a question about fractional loans that Susan might be able to share a little bit more about. I think someone was suggesting fractional loans might be an interesting approach to financing ADUs. And I think Susan perhaps had some reaction to share to that idea.
Caleb, thanks. I was actually looking at that, and I was hoping that Lori might be able to define a little bit more what she is describing as a fractional loan. I'm not familiar with that specific term, but perhaps I know it as something else.
Yeah, and Lindsay, maybe that's something that would fall under some of the private lending, maybe some cross collateralization to create the two parcels that could then later be refinanced into traditional. Is that something that's in the realm of possibility?
Possibly, yeah, depending on the lender and exactly what you're looking to do there. I mean, there's, like fractional loans in terms of, having a first and a second, like if you pull a HELOC, that's a second place loan after your first place mortgage. So that's the only fractional thing I can think of there.
Okay.
Lonnie is saying TIC loans, separate loans for several families buying a fourplex together.
Mm-hmm.
So if I understood the question, just to paraphrase, question is could something like a tenancy in common loan work for accessory dwelling units?
Absolutely.
I think so, but yeah. Have you?
So what we do is, and this solves a lot of issues with, if just one, so you've got parents have a house and one of the kids, particularly the younger kid, they want to have an ADU so that they can have reasonable housing as they get started in life. And then the other siblings get nervous. So what we do is all parties will go in on the loan, but then we title it as tenants in common. So essentially the parents still own the land and the primary home, which is maybe 85%. This is Meredith Stowers speaking. And then the kid owns 15%. So they feel the ownership. The parents are still able to provide inheritance to the other kids on an equal basis. But yeah, it solves a lot of problems, and it creates a sense of ownership among children, of everybody.
Awesome. Hopefully that's helpful information. And I'm also glad we've got a lot of the panelists here, because I saw a question earlier, which I think would be good to cover a little bit more, which is when homeowners are looking at the different financing options available to them, one of the big questions they probably have front of mind is interest rates. So I know we talked about some of the different options that are out here. I think a lot of the presentations focus a little bit more on eligibility as opposed to interest rates. So maybe we could go back around the panel real quick and get a little bit of a guidance in terms of how do these different options generally stack up against each other when it comes to the interest rates that are available to homeowners. So maybe Lindsay for some of the more conventional refinancing strategies.
Yeah, absolutely. Depending on how much you're, cash out you're pulling and what your LTV is, your rates for that are going to be just a little bit slightly higher than if you were doing like a rate and term refinance, where you're just refinancing your existing mortgage amount and just trying to get a lower amount. But I've been doing some cash out refinances that are in the high twos and low threes, and rates are around there generally when it comes to those products. And HELOCs are going to be a little higher, and that's really a portfolio product, so it will depend on the lender in terms of that one. And then, you know, private money, it just it really will depend on the scenario. But private money is not as expensive as it was. So that it has been nice. The rates have definitely come down. They're not in like the 9 to 12% as much unless you're doing something way out of the box. But yeah, I'll leave it at that, I guess.
Sure. Thank you, Lindsay. That's helpful. And I guess Meredith and Lourdes, perhaps you could share a little bit about what you're seeing in terms of renovation lending.
Yes, of course. So renovation loans right now are a little, although they're still conventional Fannie Mae and FHA, they're still a little the same as Lindsay, a little higher than your conventional loans right now, than your traditional financing. I'm not talking a big difference. It's probably still in the high 3s, low 4s. And it's only during the renovation term. Once it's complete, then I think it's just like Meredith said, we have those complementary loans that we can put them into the traditional rate and term after the project is complete and benefit from the higher value, lower interest rate, and in a lot of cases, get rid of that mortgage insurance that you may be coming into through the renovation process or the renovation financing.
Yeah, same deal. We're pricing around 3.5% right now, which is about the same as you know, a little more than a cash out. But I mean, think about that. That's free money. And when you factor in the mortgage interest deduction, your net cost of borrowing is in the 2%. That is free money. These are great opportunities. And to give you a sense, give you some real numbers, for every $100,000 you spend on construction, it's about $450 a month, more or less, something around there. Conversely, every $10,000 you spend is about $45 a month. These are great financing tools. I mean, it just makes all the sense in the world. I have never seen a renovation project that didn't, or ADU project that didn't have, based on the rental income, over 200% return on investment in terms of cash flow. With the exception of if you have a child where you're not charging any money for rent or a nominal money for rent. But it just makes all the sense in the world. Heck of a lot cheaper than apartments, right?
Absolutely. I should also mention too, like the non-QM options and no doc options are just a slightly higher than that too. So they're still a good deal, usually somewhere in the 4 to 5% range, which is, it's doable, you know, especially if you're going to refinance once you're done.
It's the opportunity premium, right? you pay a premium for the opportunity to create a greater opportunity that you can then bring back down to market rates once it's all said and done. And
yeah, using your equity to build more equity. Exactly. Yeah.
I'll also note real quick that a lot of the different financing options we talked about today are covered in the Casita Coalition's ADU Finance Guide for Homeowners. Some of the people on this panel today helped contribute to that guide. So that's the resource to refer back to if you want to learn a little bit more, thinking about the different pros and cons of these options. But I'm really glad we were able to talk a little bit about interest rates too, because I think that's always a hot topic.
All right, well, I think we got a good grasp of a lot of the questions being asked. Obviously, the contact information for all the panelists has been shared. So if you have further questions, please follow up with our panelists or with the Casita Coalition directly. You can check out the finance guide and other guides that are available. Special thanks to our special guest, Assemblymember Tim Grayson, Sharyl Silva of CalHFA, our panel of lenders, Lindsay Moon, Lourdes Hernandez, Meredith Stowers, and Susan Brown. And also, please join us for more webinars. We will continue to be hosting these the last Friday of each month from 11 to 12:30. And our next webinar will be Friday, October 29th, where Caleb Smith and a team from County of San Mateo will be sharing some of their unique approaches to ADUs. Registration is now open. You can register by clicking on the Casita Coalition events page or going to Eventbrite and searching Casita Coalition ADU. We have a very good schedule for the remainder of the year, including the City of Oakland on November 19th. If you missed any of our webinars, you can view them on YouTube by searching for Casita Coalition. Also, if you need to go back and reference anything in today's session, you can go back and search through the YouTube post once it's uploaded. We are a membership organization. If you like what we are doing, please support our efforts by joining the Casita Coalition as we remove barriers to ADUs and other small forms of housing throughout California, and including being a participant in some of the federal conversations. Also, thanks to all the speakers, panelists, and all of you, the attendees who've joined us today, submitted questions, and attentively taken notes to make sure that back in your community, you can share this information, share this YouTube video, and share the recording. Please be sure to like and follow us on social media. And thank you, and we will see you next month.
Thank you, everyone.